Right now, the fastest growing major economy on Earth is throwing a massive, unprecedented sale
Yeah, it really
on
is.
its most profitable companies. And global investors are entirely ignoring it, like completely looking the other way.
Which is just a phenomenal disconnect.
Right. Because you usually think that when you look at a country's economic dashboard and you see all the dials flashing green,
Oh, like strong GDP, rising corporate profit.
exactly, solid macro fundamentals across the board, you'd think the stock market should be hitting new highs. It feels like basic physics, you know? Good news is supposed to equal upward momentum.
It's supposed to, yeah. But for anyone managing capital right now, or even just watching global capital flows, this is arguably one of the most compelling structural mysteries in finance.
So today, we are going to dive into this deep dive and unpack this exact situation. We're looking at the Indian equity markets as of July 2026, where, honestly, the laws of financial physics seem to have completely broken down.
They really have, because the surface level narrative just doesn't match the underlying plumbing of the market at all. Not even a little bit.
So let's set the scene for you listening right now. If you were investing anywhere between, say, 2020 and 2024, you already know India was an undisputed superstar.
Oh, absolutely. Consistently one of the world's absolute best performing equity markets.
Right. Everyone wanted a piece of the India growth story. But then something highly dramatic happened recently. Since its peak in September 2024, the Indian market has basically just been, well, walking sideways.
Painfully range bound for nearly 2 years now.
Yeah, and being range-bound is frustrating, but the relative performance is what makes this a true anomaly, right?
Yeah, when you look at the historical data, the shift is violent. There's no other word for it.
Right, so between June 2021 and that September 2024 peak, India boasted a cumulative outperformance of 10% over the broader emerging markets index. It was leading the pack.
But since that peak,
Yeah, that 10% outperformance violently swung to a 40% underperformance by June 2026.
which is staggering.
It's a 50-point swing relative to its peers. So whether you are actively prepping your own portfolio for the next quarter or you're just, fascinated by the mechanics of macroeconomics, you have to ask the core question here.
Did India's economic growth engine suddenly stall out?
Right? Or is the global market just entirely mispricing this asset? Okay, let's unpack this. What is the root cause here?
Well, the data strongly suggests the latter. It's a massive mispricing. But to understand why the Indian market is behaving this way, we actually have to stop looking at India for a moment.
Wait, really? We have to look outside India to understand India.
Exactly. We have to look at the rest of the world. Because that 40% underperformance, it isn't a symptom of domestic economic decay. It's a symptom of a massive structural global capital rotation.
Okay, so money is moving. Where is it going?
The real culprit here is the sharp, almost frantic global capital flight toward a very narrow, highly concentrated group of AI-driven big tech companies.
Ah, right, the AI elephant in the room. So it's like,
Yeah.
imagine India was hosting this meticulously prepared, fantastic gourmet dinner party,
Okay, I like this.
right? The table is set, the food is incredible, the macroeconomic guests are having a great time, but suddenly, a massive, once-in-a-lifetime fireworks show called artificial intelligence starts in the neighbor's yard next door.
And everyone just bails.
Exactly.
Yeah.
Every single institutional investor grabs their coat, leaves their drink on the table, and sprints over to the fence to watch the fireworks. And they leave this perfectly good, highly profitable food totally untouched.
That analogy actually maps perfectly to the mechanics of global asset allocation because, you have to remember that global capital, even at the massive institutional level, it's a finite pool.
Right, they don't have unlimited money.
No, they have strict risk budgets. So when massive pension funds or sovereign wealth funds decide they absolutely need to heavily overweight U.S. technology stocks because they cannot afford to miss the AI boom.
That capital has to be pulled from somewhere else.
Exactly. To buy NVIDIA or Microsoft, they literally have to sell something else. And non-AI markets became the ATM to fund that rotation.
Wow, so they used India as an ATM.
Yeah, especially highly liquid, fundamentally sound markets like India, where these funds were sitting on massive profits from that 2020 to 2024 run.
So they basically cashed out their winning lottery tickets in India to go buy into the AI gold rush.
Exactly that.
And you can see the sheer scale of that abandonment when you look at the valuation compression in the source material. Let's rewind to calendar year 2022.
Okay, let's look at the premium back then.
Back then, India traded at a massive 147% premium over the broader emerging markets index.
Which tells us that global investors viewed India's structural growth as vastly superior to the rest of the emerging market pack. They were happy to pay up for it.
They were paying a massive premium for that stability. But fast forward to June 2026, and that premium has essentially collapsed, right?
Collapsed is the right word. It compressed down to a historic low of just 18%.
Just 18%. And for context for you listening, the long-term historical average premium for India over emerging markets is 73%.
So it went from double the historical average to a tiny fraction of it.
Right, it completely fell off a cliff.
And see, this is where the disconnect becomes glaring. Because what's fascinating here is when a premium collapses like that, the logical assumption is that the underlying companies must be failing.
Right, you assume earnings must be crashing, margins must be shrinking.
Exactly. But the reality is the exact opposite. India's profit share relative to its global index weight has actually hit its highest point ever.
Wait, highest point ever?
Yes. The underlying fundamentals remain incredibly strong.
That is the absolute crux of the paradox. Indian companies are currently generating a larger share of the global profit pool than ever before, yet their valuations have cratered relative to their peers.
The market is essentially pricing in a lot of bad news that simply doesn't exist in the data.
So the economic engine is running hotter and more efficiently than ever, but the price tag on that engine has been slashed.
All because the buyers are distracted by the shiny object in Silicon Valley.
Okay, hold on. Let me challenge that narrative for a second. Let me push back.
Go for it.
If foreign investors pulled out indiscriminately to chase the AI fireworks, that implies everything left at the dinner party is cheap. It implies we could just wade into the Indian market right now, throw a dart, and buy any stock at a massive generational discount. Is that actually true?
No. And that is a very dangerous assumption for an investor to make right now.
Okay, so what's the catch?
The data reveals a massive divergence under the hood of the market. This is not a blanket fire sale across the board. You really have to bifurcate the Indian market into two distinct categories to see the actual mechanics at play.
Right, so we're looking at the Nifty 50 on one side, which is the top 50 large-cap titans of the Indian economy.
Yes, the heavyweights.
And then the broader market on the other side, which includes the Nifty Mid-Cap 100 and the Small-Cap 100.
Right, we call those the SMEs. And if you go looking for bargains in that SMAT space, you are going to get burned.
Because they aren't cheap at all, right?
Not even close. The mid-caps and small-caps remain highly elevated. If we look at the PE data from June 2016 to June 2026, the mid-cap 100 is trading roughly 16% above its own long-term historical average.
Wow.
And the small-cap 100 is trading at nearly a 27% premium to its historical norm.
So they aren't on sale at all. They are arguably in deeply overvalued territory.
Exactly. They are very expensive.
Which means the entire historic discount we're talking about is hiding exclusively in the large caps, the Nifty 50.
Yes. The Nifty 50 is trading at a 12-month forward PE of 18.8x, which is nearly 11% below its long-term average of 21x.
11% below the average. And there's a brilliant visual detail in the charts from the source material that highlights how bizarre this setup is.
Oh, the historical flip. Yeah, that's fascinating.
Right, because prior to 2020, large caps were always the expensive assets. They always traded at a premium to the SMAs, which makes sense, right?
Of course. You pay a premium for the stability and liquidity of a giant corporation.
Exactly. But post-2020, that entire paradigm flips upside down. The lines on the chart literally cross. Suddenly, the massive stable companies are cheap, and the smaller, riskier companies are wildly expensive.
Why did the physics of the market invite like that?
If we connect this to the bigger picture, it comes down to the mechanics of liquidity. Specifically, who exactly is buying and selling?
Right. We talked about the foreign institutional investors, the FIIs, fleeing to fund their AI investments.
Right. And when a massive foreign fund wants to liquidate billions of dollars in Indian equities, they simply cannot sell small-cap stocks.
Because the market isn't deep enough.
Exactly. The small-cap market isn't liquid enough for that kind of volume. If they tried to sell billions there, they would crush the price to zero before they could even get fully out.
So they have to sell the highly liquid large caps, the Nifty 50.
Yep. The foreign flight hit the top 50 companies like a sledgehammer, simply because that was the only place the foreigners had enough liquidity to cash out.
Okay, so that explains why large caps tanked. But why are the small caps so expensive? Because on the other side of the equation, you have the domestic retail investor in India.
Everyday people putting money into mutual funds.
Everyday people, systematic investment plans, all of that. Post-COVID, there has been incredible exuberance among domestic retail investors in India. And domestic money, especially retail money, tends to chase high beta growth.
They want the multi-baggers, the huge returns.
Exactly. So they flood into the mid and small cap space.
So you essentially have two completely isolated pools of capital operating in completely opposite directions.
Precisely.
The massive foreign money drained out of the large caps, driving their valuations into the floor, while the domestic retail money flooded into the small caps, driving their valuations through the roof.
That is the exact mechanism. The domestic enthusiasm completely insulated the smaller companies from the foreign sell-off. And it leaves us with this bizarre reality where the most stable companies in the country are the cheapest assets on the board.
Okay, so understanding that the Nifty 50 large caps are where this rare sale lives, we really need to look under the hood and stress test the actual businesses.
Definitely. Because a cheap multiple doesn't mean much if the underlying business is rotting.
Right. We need to know if paying this discounted price is actually a smart move, or if it's a value trap.
And that brings us to an incredibly rare fundamental setup highlighted in the exhibits. The data provides us with two crucial metrics that are currently moving in opposite directions.
Price-to-book ratio and return on equity.
Exactly. PB and ROE.
Let's talk about the relationship between those two, because that's where the value story gets really compelling for an investor. Normally, if a company becomes more efficient and generates a higher return on equity, the market recognizes that improvement, right?
And they charge you a higher multiple for its book value. Rational pricing dictates that a better engine costs more money.
That is how the market functions 99% of the time. But right now in the Nifty 50, that relationship is completely decoupled.
Completely. The 12-month forward price-to-book ratio for the Nifty has dropped to 2.7x, which is below its 10-year average of 2.9x.
So the actual price tag on the assets has visibly shrunk.
Yes. But simultaneously, the return on equity is up. It has climbed to 14.5%, which is well above its 10-year average of 13.7%.
So what does this all mean? In plain English, you are paying less money for an engine that is currently generating more profit.
Yes.
That is the holy grail of value investing.
It really is. You are getting higher quality for a lower price, entirely because the traditional buyers, those foreign funds, are structurally forced to look the other way right now.
And it is crucial to note that this isn't just a backward-looking anomaly, right? The macroeconomic forecasts indicate this profitability is highly resilient.
The macro resilience here is actually astounding, though, to be fair, there were some minor earnings cuts mentioned in the recent data.
Right, let's dig into that resilience because it wasn't entirely perfect news across the board.
True. If we look closely at the upcoming fiscal years, there were minor downward revisions, about 0.8% cuts to earnings per share in specific sectors.
Like telecom, logistics, healthcare, BFSI, and consumer.
Yes, those sectors.
Right.
But in the grand scheme of the index, those 0.8% cuts are basically rounding errors. Even factoring in those downward revisions, the Nifty EPS is still projected to grow at a massive 15% to 16% year over year through fiscal year 27 and fiscal year 28.
Just think about that. You're looking at 15% to 16% compounding corporate earnings growth, while the market is pricing these companies as if they are stagnating.
And we can zoom out even further to the macro level to see how de-risked this market has actually become.
Let's talk about the market cap to GDP ratio.
Often called the Buffett indicator, it measures the total value of the stock market against the actual size of the country's physical economy. Back at the peak in September 2024, that ratio was extremely frothy, hitting around 150%.
Meaning the financial market was running way ahead of the physical economy. It was getting expensive.
Very. But today, that ratio has cooled off significantly. It is projected to moderate down to 124% for FY27.
But the way it cooled off is the critical part here. It didn't cool off because the stock market crashed.
No, we didn't.
It cooled off because the denominator, the actual physical economy, is growing so fast that it's catching up to the market valuation.
Precisely. Nominal GDP growth is expected to actually accelerate to 11.5% in FY27, which is up from 8.9% in FY26.
Wow. So the underlying economy is speeding up, corporate earnings are growing at 16%, profitability is above the historical average, and yet the valuation multiple is historically cheap.
The fundamental floor underneath these large caps is incredibly solid.
Which naturally leads to the execution question. The table is perfectly set. We have pristine fundamentals and cheap large-cap valuations. But an undervalued market can stay undervalued forever without a trigger.
This is the classic value investor's dilemma.
Right. What actually forces the market to correct upwards? What actually makes the crowd leave the AI fireworks show and come back to our dinner party?
That is the exact question every fund manager is asking. And our sources highlight two very specific key themes to monitor as the Q1 FY27 earnings season kicks off.
Okay, what's the first one?
The first is the dynamic of those foreign institutional flows we've been talking about.
The FIIs. The anchor that's been dragging the large caps down.
Exactly. But the map here heavily favors the upside because we don't actually need a massive flood of foreign capital to return to trigger a rally.
Wait, we don't.
No. The domestic retail and institutional inflows in India have been so consistently strong that they have essentially been absorbing the brunt of the foreign selling.
Ah, so if the domestic money is already acting as a massive counterweight, what happens when the foreign selling just stops?
That is the trigger. If foreign investors merely shift their stance from aggressive selling to a neutral stance, the downward pressure evaporates.
You don't even need them to become aggressive buyers.
Exactly. The moment that foreign anger is lifted, the relentless upward pressure of the domestic inflows becomes a massive, pure tailwind. It will naturally push those large cap valuations back toward their historical averages.
It's like removing a massive dam.
Yeah.
The domestic capital is already flowing. You just have to stop blocking it.
That's a great way to look at it.
Okay, so foreign flows neutralizing is catalyst number one. What is the second theme to monitor?
The second catalyst is a profound stress test of the market's internal liquidity, coming in the form of primary market supply.
Oh, the IPOs.
Yes. There is a gigantic wave of initial public offerings and capital raising slated to hit the Indian market soon.
And these aren't small companies either. We're talking about massive multi-billion-dollar listings. The sources list Geo Platforms, the National Stock Exchange itself.
SBI Funds Management?
Yeah, and Zepto, PhonePe, and Oyo.
It is a staggering amount of equity supply being dumped onto the market all at once. And mechanistically, when massive IPOs launch, they drain liquidity from the secondary market.
Right, because institutional investors want to buy into those new exciting listings. But they don't always have billions in unallocated cash just sitting around.
So they sell their existing holdings in the secondary market to raise the cash to buy the IPOs.
Which creates massive selling pressure on the broader market.
Normally, yes, it does. But here's the bull case. If the Indian market can absorb this colossal wave of primary supply without dragging down the secondary market, meaning there is enough sidelined fresh capital entering the system to buy the new IPOs without having to liquidate existing holdings.
That is a massive green flag.
A huge green flag. It will prove unequivocally that the underlying liquidity conditions are robust enough to support a sustained rally.
Okay, so if we see foreign selling neutralize, and the market swallows this massive wave of IPOs without choking, what does the actual destination look like? What are the mathematical index targets for this setup?
The structural models give us clear parameters for the BSE Sensex. As of our anchor date on July 2, 2026, the index is sitting at roughly 77,502.
Okay, 77,500.
If this mean reversion triggers, the base case target for December 2026 is 89,000.
Wow, 89,000. That is essentially a 15% upside in just 6 months, driven purely by valuation normalization.
Correct. And if we look a bit further out, the probability-weighted outcome points to a target of 86,000 by June 2027.
So the risk-reward asymmetry here heavily favors the upside.
Heavily, specifically if you are allocating to those large-cap, historically undervalued titans.
It's just a fascinating map of the macroeconomic territory. Let's synthesize this journey for you, the listener.
Let's do it.
You now know that India's dramatic stock market underperformance over the last 2 years isn't actually a sign of economic decay. It is essentially a mechanical byproduct of the global obsession with artificial intelligence.
It's the fireworks show next door.
Right. And that frantic global capital flight has created a highly specific, historically rare anomaly. Large-cap Indian equities are simultaneously generating above-average profits while trading below their historical price-to-book average.
It is a textbook example of market mechanics and global liquidity flows entirely obscuring the fundamental reality of the underlying businesses.
Which is a powerful reminder that the most profitable investments often require looking where everyone else isn't looking, finding the quiet value while the rest of the world chases the shiny new thing.
And having the patience to wait for the liquidity cycle to inevitably turn.
Exactly. Which leaves us with one final, slightly provocative thought to mull over as you look at your own macro models or portfolios.
What's that?
Well, we've established that the violent global rotation into AI is what drained the capital from emerging markets in the first place, right?
Right.
But what happens to those markets if the AI bubble pops? Or, even more realistically, what happens if the AI hype just plateaus, as the technology matures and those massive capital expenditures normalize.
That capital cannot just evaporate. It will have to rotate back into fundamentally sound growth assets.
Exactly. Could the end of the AI gold rush trigger the single largest, fastest flood of returning foreign capital into fundamentally pristine markets like India?
It's a very real possibility.
We've spent this whole deep dive looking at domestic Indian metrics. But the catalyst for the next great emerging market boom might actually come directly from a missed earnings report in Silicon Valley. Keep an eye on those global tech earnings, because the fireworks show next door is eventually going to end. And when the crowd turns around, they're going to realize there's a massive, highly profitable feast still waiting on the table.